Hi, everyone. Welcome to this episode of the View podcast. It's been a big day in the market today, so we wanted to come here and share our current thoughts on the market. Rob, last night, President Trump announced his plans for tariffs, finally, and the market has had not a very good reaction at all.
Time to react.
What would you tell people who are concerned about the market right now, concerned about the drop, concerned about tariffs and their effect on the economy?
Yeah, it's a great question. It's on everyone's mind. And essentially, last night, what the markets perceived we would get in anticipation of the presidential announcement on tariffs was certainty. And ultimately, what we ultimately got was more uncertainty. In fact, we did get certainty on at least what President Trump's and his cabinet's aiming to do in terms of bringing back industry to the United States, making reciprocal tariffs play out, leveling the playing field. But right now, that is disrupting the global markets. And so we're seeing not only the United States sell off about 5% on some respective indices, you're also seeing global markets sell off. And Madison, that's simply because of the uncertainty. Anytime we have uncertainty, markets don't like that. Then we have extreme volatility. So you're seeing volatility rise. And this is a natural reaction, a knee-jerk reaction to this, because we don't know yet how this is going to play out. In fact, the administration doesn't know yet how this is going to play out. It's actually going to take some weeks, even months, for this to settle in and really figure out from just how it's going to balance out, right? So the president, in traditional fashion, overreaches with his ask, right? When you're doing the art of negotiation, and let's say you and I are negotiating on a car, right? And I want to sell, or you want to sell a car for $50,000. And I come in and say, nope, the car is worth 25. I'll give you 25,000. And you look at me like you just insulted me.
Right.
And I walk away. And then you think about it, and I know that you're not going to take $25,000 because that's not even close to fair market value. But I really want to get you off of your position when I negotiate, just for you to come down from that 50,000, right?
Right.
So then that starts the negotiation. So what I believe is going to happen is other countries are going to now come back to the table and say, you know, you can't be serious about the 10% across the board on every country, or the extreme, depending upon what, if it's Mexico or Canada or even China, you can't be serious about those high taxes or tariffs, if you will. And now the negotiating begins, and that's why it's going to take some time. So this is going to take some time. We're still going to see extreme volatility. I truly believe long-term, for, you know, if you have a long-term mindset, especially from an investor standpoint, this will play out in your favor. If you buy high quality, good quality, large cap companies that are selling off at a deep discount for a lot of the headline reasons, you know, we will get certainty at some point in time.
Right.
We're going to see that. It's not going to be like this forever. And there's also going to be some safety valves built into the market where later on, let's just look later on this year, Congress is looking to pass the extension of the 2017 Trump tax cuts. Well, that's more liquidity, more sort of opportunity for businesses to get incentives, to have more certainty on their business spending. And whether they do CapEx or additional hiring or acquisitions, so on and so forth. So, or individuals to know, hey, listen, my taxes aren't going to go up next year. So there's certainty down the road. We just have to get through this rough patch at this moment. Another thing I'll say, and a different way of thinking about it is, you know, Trump is going through this unilaterally. And so he knows he has some good, it's a family conversation, right? The globe, we're all connected globally right now through trade, through everything else. And so what Trump is essentially doing is sitting the family down to the table and having his kids sit down and saying, everyone's cut off. Everyone's cut off from the family cell phone plan. Everyone's cut off from the supplemental income that I've been giving you. And so now everyone's saying, are you kidding me? I can't pay my own bills, or I can't get off the family plan because it's a bundled plan and it's actually really good for all of us. And then yours is going to go up and mine's going to go up. And he just wants, and he can't just pick out one son or one daughter or one child and say, you're off the plan and you're not. So what he does is he says, that's it. We're cutting it off. And ultimately what that means is it's mom and dad savings and loan, because the United States, by way of our tariffs, are really supplementing the world. Now, let me give you another example. Let's say we have an avocado producer, or even let's use a grape producer, okay, in the Coachella Valley. Okay, and they're growing their grapes here, and then they're exporting them, let's say to Mexico as an example. So for that export, Mexico puts on a 10% tariff, okay, right now. That grape grower with that extra 10% tariff, guess who offsets that? The federal government. So the federal government gives subsidies to the farmers to offset so that that farmer could pay his family, pay his employees, or pay food on the table for his family, pay his employees, and keep operations moving and keep that agricultural, machine going. But then that tax is, collected by Mexico. Now, if the United States is offsetting by a subsidy to that farmer here, okay, the United States has deficits and national debt, okay, $36 trillion in national debt. So if they're doing that to every single business that have to export from the United States, grown here, produced here, made by U.S. workers, and then every business in their respective industry has to do the same respective thing, but the U.S. government, mom and dad savings and loan, has to come in and say, okay, here's 10% offset for you. Here's the 25% tariff that you're getting on your goods and service. And then what do? We then go to the market and we sell U.S. treasuries because we don't have the money. We're funding all of this. So we're selling the treasuries to China, and China is buying our U.S. treasuries. So we're going deeper and deeper and deeper in debt. That can only last for so long. So if mom and dad savings and loan go under, okay, they can't take out a home equity line of credit anymore. They can't go get extra lines of a personal loan anymore, right? Their credit is tapped out. If that particular situation plays out long term, and that's sort of what the fiscal issue is right now. If that plays out, the kids won't have any subsidies, right? Or support, because mom and dad are out of business. They're bankrupt.
Everyone will be less better off if this doesn't happen right now in the long run.
Yeah, it's just a case of accountability. Who's paying for what, and how justified is it? Is it justified that the U.S. government has to continue to fund in deficit spending by selling U.S. treasuries to offset a tariff that's imposed to a good or service that we export? That we're basic. It's just a never-ending circle. And I don't think if it's explained like that, I think it's easier to understand for the public. But right now we've got a lot of uncertainty and turmoil that provides volatility. But that volatility, again, if you're a long-term investor, provides a tremendous opportunity. So longer term, I think, better things will come of this, but short term, it's a conversation to have and say, hey, should we be worried about this?
Right.
What we do for our clients before we even get to a point like this is what we have is the balance and diversification, as you know, as we structure our portfolios. And it's called the I don't know strategy, right? We have exposure to every sector. We have exposure to international. By the way, international is one of the leading markets in the U.S. this year. And
right.
And it wasn't last year. The U.S. was, so we expose our clients to all the aspects of what the market has to offer. So a little bit in each category. And by blending that together, you get basically black on the chart that we're showing right now. And that's called a diversified portfolio. And what's going to happen is you're not going to be at the bottom. So you're not going to be a loser, every single year because you had to put all your money on one particular sector and make that one bet that didn't pay off. And that's how often investors get off kilter, if you will, or imbalanced or take on too much risk. Conversely, you're not going to be at the top every single year, but you're going to be right in the middle. And that balance keeps your portfolio volatility at a minimum. And
right.
That's what keeps you engaged and say, you're going to basically, when the market goes down, like today, if you have a well-balanced, diversified portfolio, you're not going to go down as much respectively as the market.
Right.
Conversely, when the market goes up, you don't have to make up that much because you didn't go down that much. So you're winning by not losing. So it's a sound strategy that we employ for our clients so that we can take advantage of strategic rebalancing when the market is down. So we take out some sectors that are working and we reallocate to some sectors that are undervalued right now. And that's how we win for our clients as well.
Rob, what percentage of revenue does our country collect from tariffs?
Well, it's interesting to know that actually it was the 16th Amendment that was passed in 1909 and then ratified in 1913. In 1913, a percentage of tariffs that were collected by the U.S. was 45%,
Wow.
which means we were getting majority of our revenue, almost half, to the United States by way of tariffs from other countries, right? It all changed. And when it did change, gradually went down to 2%. So if you're taking away the revenue that we would receive globally from tariffs, where's the offset? Where are we going to get it? Comes from you and I. And it was shifted to basically the U.S. Consumer ultimately over time. So we're trying to maybe not go back to 45%. The administration's reaching for 25 right now, from 2% to 25. That's why it seems extreme.
Right.
But will we land on 25? Most likely not. What does 25% mean? If we actually achieve that goal, $600 billion in additional revenue. How much do we bring in from just corporate taxes in the United States? $532 billion.
Wow.
So immediately we would basically double the revenue to the United States to offset deficits, to offset and pay down our national debt. And that's the ultimate goal, to have fiscal responsibility.
Right.
And then ultimately go to the U.S. consumer and say, hey, listen, it may seem like you're going to get higher inflation. And that's the fear. That's what the market really is, the uncertainty. But the first Trump 1.0, the first administration of Trump, put $300 billion of tariffs on China, day one. Okay. And the
market had the same reaction.
It did have the same reaction, and then it recovered. And then we had President Biden comes in, and everyone thought he was going to get rid of the $300 billion Trump tariffs to China. And he looked at the balance sheet fiscally and knew that he couldn't get any of his agenda through. We couldn't pay our bills. We actually needed that. And actually China didn't really back off on that $300 billion. So Biden kept him in. So now we have proof over the last 8 years and 2 separate administrations that the tariff wars or imbalances could be playing out favorably, where it's fair and balanced for both sides.
Awesome. Well, thank you for sharing that with us, Rob. I hope that provided some people some ease on a day when the market is down so much. And thank you for listening. And stay tuned for our next episode of the View Podcast.
This podcast is brought to you by David Field Producer. It is produced and directed by David Field and Kristen George. And its mix, edit, and socials by Kristen George. Blanky Shine Wealth Management is a group of investment professionals registered with Hightower Services, LLC, member FINRA and SIPC, and with Hightower Advisors, LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities, LLC. Advisory services are offered through Hightower Advisors, LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analysis, prices, or other information contained in this research is provided as general market commentary. It does not constitute investment advice. Blanky Shine Wealth Management and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This document was created for informational purposes only. The opinions expressed are solely those of Blanky Shine Wealth Management and do not represent those of Hightower Advisors, LLC, or any of its affiliates.